Ever feel like your investments are a roulette wheel spinning out of control? My name is Nova, and I spend way too much time thinking about investing mistakes. If you're someone who wants to stop losing money, hit the subscribe button and give this video a thumbs up. Let's dive into the first mistake that can cost you thousands. First mistake, putting all your eggs in one basket. Concentration risk is when you rely on one investment for all your returns. According to the CFA, 10% of investors lose 30% or more because of concentration. Imagine putting $100,000 in a single startup you think will skyrocket. In reality, the company's share price dropped 20% in just 6 months. The illusion of control makes us overestimate our knowledge. Overconfidence can push us into risky, undiversified bets. When a market turns, that 20% drop can wipe out $20,000. The fix? Spread your bets across sectors and asset classes. Index funds give instant diversification for a few dollars a share. Asset allocation balances growth and safety in your portfolio. A simple 70-30 mix of stocks and bonds is a good starting point. Don't forget to diversify across regions too: US, Europe, Asia. A well-diversified portfolio is a safety net for life's storms. That wraps up the first mistake. Let's move on. Second mistake, chasing the next hot stock and timing the market. Everyone wants the next big thing that's going to explode. But research shows timing the market costs investors $4.1 trillion annually. You can't predict the best entry or exit points consistently. Instead, focus on long-term growth and regular contributions. Dollar cost averaging smooths out volatility over time. Think of it like buying groceries each week. You get a better price on average. When markets dip, buy more. When they rise, you've already built the position. Chasing hot stocks often leads to buying high, selling low. That's why many beginners end up with a portfolio that lags the market. The psychology of FOMO pushes you to invest at the peak. Instead, stick to a disciplined plan and let compound work its magic. Set a target return and stay the course through ups and downs. Remember, the market's a marathon, not a sprint. That's the second mistake. Keep your focus on the long haul. Third mistake, ignoring the hidden fees that eat your returns. Fees can range from 0.5% to 2% annually, and they pile up over time. The 2019 Morningstar survey found investors lose 1% each year to fees. That 1% on a $100,000 portfolio equals $1,000 per year lost. High-expense mutual funds are the biggest culprits. Index funds typically cost 0.03%, a fraction of that. Don't overlook transaction costs, broker fees, and taxes. Every trade you make can add to the drag on your growth. To minimize costs, choose low-expense ETFs and limit trades. Use a brokerage with zero commission for US stocks. If you're a beginner, robo-advisors often have competitive fees. Review your fees annually. Even a 0.2% reduction can save thousands. Set a fee budget before you invest, then stick to it. Lower fees mean higher compounding. It's a simple math equation. That's the third mistake. Watch your expenses closely. Fourth mistake, forgetting to rebalance your portfolio over time. When one asset grows faster, your portfolio shifts away from your plan. If you plan 60-40 stock bond, but you're now 75-25, that's a risk shift. Rebalancing realigns your holdings back to the target mix. It forces you to sell some winners and buy lagging sectors. This discipline keeps risk in check and captures gains. You can do it manually or set up automatic rebalancing. Many robo-advisors rebalance quarterly at no extra cost. Ignoring rebalancing can double your expected risk over a decade. The psychological trap is the buy high, sell low mindset. Instead, think of it as a maintenance check on your financial car. Set a simple rule. Rebalance every 12 months or when the allocation shifts by 5%. It keeps you from riding out market swings unnecessarily. Rebalancing is a small task that can save you from big surprises. That's the fourth mistake. Keep your plan on track. Fifth mistake, letting emotions drive you to sell during a downturn. It's natural to worry when the market falls 10% or more, but panic selling can lock in losses and miss the rebound. Statistics show that investors who sell early underperform by 8% on average. Psychology, loss aversion makes us fear losing more than we value gains. Use a stop-loss threshold that's realistic. A stop loss protects you from extreme crashes, not normal dips. Remember, the market is cyclical. Downturns are temporary. Use dollar cost averaging to buy more when prices are low. Think of your portfolio like a garden. Sometimes weeds fall. Plant the seeds now and let the money grow when the season changes. If you're nervous, consider a part-time robo-advisor to hold steady. The key is a clear plan and sticking to it during stress. Avoid the urge to chase short-term noise. Focus on your long-term horizon. That's the fifth mistake. Keep your emotions in check. You've just seen the 5 biggest investing blunders. Now it's your turn to review your own portfolio. Ask yourself, am I diversified, rebalancing, and avoiding hidden fees? If any of those answers are a no, start fixing them today. Remember, small habits build up to huge wealth over decades. Set a simple budget for fees, a 70-30 allocation, and a yearly rebalancing. Use low-cost index funds, dollar cost averaging, and a clear plan. And when the market dips, stay calm. Your strategy will pay off. You've got the tools, the knowledge, and the mindset to grow. Take action now and watch those mistakes turn into stepping stones. Every dollar saved from a mistake is another dollar working for you. Good luck, and may your portfolio soar above the rest.